tomorrow, we have a session specifically looking at, can we scale the technology for narrow body aircraft, and what does that mean for the aircraft, and what would it mean for hydrogen infrastructure at airports? So we look forward to that one tomorrow. But we've got one more session for everyone today, and I think on panel 3 we talked a little bit about Christmas wishes. Imogen asked the panelists what would be their Christmas wishes, and one of those certainly was more money. Right, we need to progress this technology quickly to make the R&D go, so we can meet some of these emission removal goals. We really need to have rapid scaling, and that takes resources and it takes money. So no better segue then to move on to our final panel of the day, which is focused on financing truly clean flight, and is an investor deep dive with some leading investors, leading VCs, and some institutional investors as well. And so I'll hand over now to our Chief Investment Officer, who's in really good place, Katya, who is our Chief Investment Officer and will be the moderator of this panel. Katya, are you able to give a little bit of an introduction to what we're going to cover today, and then also to the panelists we've got for this session?
Yes, absolutely. Thanks, Dom. So hopefully you can all hear me. So yeah, just to repeat, we are unfortunately the last panel of the day, but we'll do our best to keep it lively and keep it interesting. So yes, as Dom said, today we'll be discussing how to finance truly clean flight. Now, financing hardware innovation has always been a challenge. There was a brief period of cheap and easy money back in 21-22, but now we're back to a more normal environment. So today we really wanted to have a lively discussion about what companies, but also other market participants, can do to overcome some of the key challenges that we face as we progress down the capital stack. So first of all, just a quick introduction to myself. So as Dom said, I'm Katya. I'm the Chief Investment Officer of ZeroAvia and have been with the company for about 4.5 years, so almost since the beginning. And my primary responsibility has always been for fundraising, investor relations, and corporate development. This panel comes at a good time on our journey on that front. So slight shameless plug here, but we just yesterday announced the final closing of our Series C, which was co-led by Airbus, Neom, Barclays Impact Capital, and had significant participation from UK Infrastructure Bank. So hopefully we can use our experience also as a bit of a case study as we launch into the discussion later today. But enough about me. So I've got an amazing panel with me today who have experience really across the whole capital stack. So I'll just quickly introduce them, and then we'll hand over to each participant to give a bit of an opening statement. So today we have Kirsten Garcia, who is partner at Breakthrough Energy Ventures, who led our Series A and remain one of our largest institutional investors to date. We also have Phoebe Wang, who is investment partner at Amazon's Climate Pledge Fund and was previously at Shell Ventures, both of whom have been participating in our funding round since the Series A, and Phoebe's been a big champion of ours. We have Kieran Mahanty, who is a director at Teachers Venture Growth. We have Kirsten Bartok Touw, who is a managing partner at New Vista Capital. And last but not least, we have Kim Zhu, who is CEO and co-founder of Sightline, or previously known as CTVC newsletter, who I'm sure many of you read. So really looking forward to the discussion. And now I'm just going to hand over to each participant to give a bit of an opening statement about how you've experienced the recent changes over the last year, what you've seen from your lens has become more challenging, less challenging, and any initial words of wisdom you have for companies that are looking to finance at various points of the journey. So Kirsten, maybe I'll start with you, please.
Yeah, thanks, Katya. So yeah, thank you for having me, and pleased to be here. As you mentioned, Breakthrough Energy Ventures is a climate fund, venture capital fund focused on climate. The way that we've generally approached most of the things that we target is to try to focus on big problems. Where do the emissions come from? What are the areas that are very hard to abate or reduce carbon emissions? And aviation is obviously one of those. And so, right off the bat, we have tried to look at innovative propulsion technologies, looking at things that can get to market within the next decade, looking at technologies that we think are certifiable, but are still, obviously we are early stage investors, and so we look to frankly invest ahead of the pack. And as you mentioned, we were investor in ZeroAvia at the Series A round, probably at a time where hydrogen aviation was a bit more controversial than it is today. I'm pleased to see that there's been more of a market movement towards the potential of hydrogen and fuel cell aviation. And so that's generally how we approach things. I mean, as you mentioned, the last, I would say, 2 years have been challenging for taking big shots and doing moonshots. And so how companies think about the way they're going to evolve towards, solving big problems it has changed, and we can talk more about that. I don't have to cover that in my opening remarks, but definitely I think it's important for companies to have strong financial backing, and be somewhat nimble and ahead of the curve as they see the markets changing, which they have.
Awesome. Thanks, Christian. Now, Phoebe, maybe handing over to you.
Sure. Yeah. Thanks, Katya. And great to be on this panel. So my name is Phoebe Wine. I'm an investment partner at Amazon's Climate Pledge Fund. We are a $2 billion fund really focused on sustainability and climate tech. It's 3 years old, but we have invested in over 25 companies and then really in a wide range of different sectors, right? So mobility is one of the top one, and where like ZeroAvia is in our aviation mobility portfolio. And then we also invest in energy production, utilization, and storage. As well as circularity and food and agriculture, etc. So coming this year, we also start low power compute, really kind of focus on data center technology as well. So that aside, I think the past year just kind of double click on the trend that Christian has mentioned, right? We have seen probably one of the slowest year in VC industry, but I think for the climate tech, it's actually more resilient than a few of other industries. So it is good news for climate tech investors and then also entrepreneurs, because like we're in this existential problem area, right? So it is important for us to continue the work and then continue investing and innovating in the space. Specifically for aviation, we still believe that this is one of the hardest to abate area for carbon emission. So things like I know that there are a lot of emphasis on alternative fuels, right, SAF, etc. But then if you're looking at energy density, hydrogen is actually really important and would be really helpful if we were able to get to that breakthrough. So still, like from our side, we still remain very positive. And then if you're looking at our portfolio, we are pretty heavy on hydrogen as well. Yeah, so around the words of wisdom for entrepreneurs who wants to kind of continue working on it or thinking about starting a company in aviation or in climate tech in general. So I've been in the clean tech or climate tech industry in the past 12 years, have seen the booms and busts, right? But then I think the ultimate important rule is find an area where you can find a large enough problem and then really get the product market fit solution to it. And I think more importantly, make sure that you have the solid unit economics, solid go-to-market strategy, because I don't think the subsidies are going to be there forever. So being able to kind of stand alone when the wave comes in and come by, right? So I think that's important. So I'm going to pause there and I'll pass over back to Katya.
Great, thanks, Phoebe, and we'll come back to all of you with some more detailed questions later. Kieran, it would be great to hear from you next.
Yeah, thank you so much. And again, thank you for hosting us here. So I sit in a group called Teachers Venture Growth, which is the early stage investment arm of Ontario Teachers Pension Plan. That plan is a $250 billion pension fund doing exactly what it says on the tin. So looking to invest in great companies in order to pay the pensions of current and former school teachers from the province of Ontario in Canada. And so as a kind of venture stage investor in that group, I think of my role really as having three elements to it. One is clearly to find great venture growth stage businesses and drive higher returns across the fund, kind of same as any other venture fund. I think in addition to that, I'm investing on behalf of 330,000 school teachers, and I think that comes with a degree of responsibility to invest with purpose and to leave a positive impact on the world. And that's the number one point we hear from those stakeholders, is that they want to see us investing to drive the climate transition and to be at the vanguard of that. So it's a priority for kind of my group, but also the broader fund. And I think that's the third piece, is that we're a kind of relatively small piece of an overall $250 billion fund. So an important part of what my team does is to look beyond the horizon, look at the technologies and companies that are really going to transform the way the rest of the portfolio needs to interact with the ecosystem. So a good example for the current conversation, we have 5 airports in our portfolio. It's got something like 70 million passengers served annually. All of those have net zero targets in place. All of those I know are kind of working hard on how they address their emissions. And it's clearly a challenge that's been discussed all day. But I think the extent to which we as a venture team can help find great businesses and from on one hand, kind of support our portfolio in getting early engagement with them, and on the other hand, support those investments with strategic collaborations. That's kind of something that an important part of our value add story. And I think to the question of, the last year or so, we retain the same core approach. We still, we talk about investing with patience and taking a long-term view. And I think it's, market turbulence has been a good time for us to kind of continue to reiterate that. Certainly still have the same conviction on climate, kind of still very front of mind to us and our portfolio companies. I think maybe the kind of nuanced compared to some of the other panelists, whereas Kirsten talks about kind of being very early and getting in ahead. For us, we're relatively late stage within the venture ecosystem, and so kind of clearly wanting to see businesses with a proven model, with a lot of the technology de-risked. And so I think that's often the challenge point that we have when we're engaging in climate tech businesses, is when do you get to that point where it's the right point for us to be engaging and hopefully investing.
Super, very helpful. Thank you. Kirsten, can I come to you next, please?
Absolutely. Hi, Kirsten Bartok, Touw. I'm a founder and managing partner of New Vista Capital, which is an aerospace and defense investment platform. We provide venture capital, strategic advisory, and private equity for those sectors. I also am a partner at a company called Air Finance, which is an aircraft financer supported by global export credit agencies for the aircraft industry. It's been around for about 15 years. Similar to ZeroAvia, we believe that technology trends in autonomy and alternative sources of propulsion, advanced materials, are going to lead to an eventual entirely different aerospace ecosystem. The forms, the wing, the tube and wing that people are accustomed to will no longer exist because of advanced propulsion technologies and innovations along the way. This is also going to be pushed with aerospace's growing percentage of the overall carbon footprint as other sectors make advancements in aerospace, because of the long capital intensive nature of the business and life cycles, is going to find it harder. So this is a stickier problem, and I appreciate everyone on this Zoom who is addressing it. Back to, I think, the earlier point that you mentioned, Katya, is that it's also a difficult time for capital intensive businesses and those with long time horizons and that are highly regulated. As capital has gone up, so has the bogey and the difficulty in raising capital for later stage rounds. On a positive note, and we'll spend more time talking about this later, I think you also see more non-dilutive sources of capital leaning into this sector, whether it is industrial policy or opportunities for governments who are looking at the instability in the geopolitical landscape or the techno-economic war. So we're seeing more and more support from groups like NATO Investment Fund or export credit agencies focusing on domestic earlier stage technologies, DOE, DOD, matching funds, the Office of Strategic Capital. And I do think that they are going to be a supportive nature and a more patient partner as we go through this. The question is, can they get there in time to provide that lower level of capital that we're going to need to meet the requirements of getting to TRL 9?
Absolutely. Thank you. Right, Kim, it would be great to hear from you as well.
Awesome. Well, great to see everyone. So even though my name tag says Climate Tech VC, coming at this from actually a non-venture investor perspective. So for some background, we started off as Climate Tech VC, or CTVC, which was a newsletter tracking the climate tech, early stage climate tech space in 2020. Since then, we've expanded into a market intelligence company on climate tech called Sightline Climate. So we still have the newsletter, CTVC. It's completely free, about 60,000 subscribers. But what we really do at Sightline Climate is our goal is to bring clarity to the new climate economy. So we provide data, tools, and research frameworks to really help investors, corporates, and governments build and finance the new climate economy, with hard to abate sectors like aviation being a core component of that. And of course, we produce CTVC, which is the free newsletter that encapsulates a lot of this. So I'll start with a funny line that my co-founder likes to say when we think about climate tech and where it needs to get to, where some of these harder to abate sectors need to get to. Ideally, things get too boring. And boring sounds bad, but boring is actually good. Boring is banks and project finance, similar to solar and wind. It's being able to build and fund these things at scale, whether it's, project finance or corporates being able to scale this. And since we've been tracking this climate tech space as a whole, we've been noticing a shift from, venture funding, R&D, now starting to shift towards deployment over the last year or two. And so you start with R&D and innovation in the lab, then you get venture funding to build the startups and pilots, maybe, fund some of the early demos. But then there's this cliff or valley of death, as many in the space like to call it, past that pilot or demonstration stage, which in these harder to abate and capital intensive sectors, we're seeing a lot of this cliff. Especially with that cohort of early stage climate tech companies starting in, 2019, 2020, starting to reach that stage. And so what do you do about that? You used to be able to count on venture capital or growth maybe to fund that. 2021, there was the era of SPACs maybe to fund that as well. But now the private markets have changed, as some others have noted. Venture capital, we track venture and growth capital in climate tech. And in 2022, there was about 40 billion. In 2023, so far, year to date, there's been about 28 billion. So there's still capital coming into the private markets, but really that drop-off has been in that Series B to growth stage. So venture and growth to get that over the hump. At the end of Q3 this year, Series B to growth funding was about 16.7 billion, which is down 33% compared to the prior year. So what does this mean? It means that we need different financing. We need different bridges to enable crossing that gap. The first one, as someone mentioned, is public financing. So both in the US and Europe, we're seeing different mechanisms for this. In the US, there's the US Loan Programs Office, Department of Energy Loan Programs Office. In Europe, there's European Investment Bank and country-based funding pools that are trying to help enable and catalyze these capital-intensive technologies. And then the second financing bridge we're seeing is a more diverse and growing capital stack. So more types of financing like pension funds or sovereign wealth funds entering the space, more corporates as well, helping to finance with balance sheets, and then more kind of what we call emerging or growth infra investors that are willing to take on a bit earlier risk and maybe do hybrid crossover into corporate equity. So happy to speak more about what we're seeing in the market, but definitely lots of interesting shifts in the climate tech funding market.
Awesome, thank you. It's also a great segue to all the questions I wanted to ask. And I think, certainly we have experienced a sort of value of death phenomenon with our last round, and I'm sure that we'll experience the same when we go to the market for Series D in sort of 6 to 9 months time, where, especially for a technology like ours, we're looking at technology risk, regulatory certification risk, market risk, and scale up risk. And it's just quite a lot for investors to digest. And I think so we get hit arguably the hardest by that valley. And certainly from the company perspective, it does feel like there's a shortage of capital somewhere in the middle, but it'd be great to sort of unpack maybe how the different institutions play in that through the questions I've got. So Phoebe, I want to start with you. It's a bit of a maybe sort of obvious question, but sort of what's the role that corporate venture capital firms can play, and how you have experience in a few of them. So it'd be great if you could talk to different roles you've seen play in different rounds, and maybe how that's evolved over time and how it's worked well and maybe less well in certain different examples.
Yeah, absolutely. So I think in terms of the corporate venture capital, it's first of all, as a VC, right? So it's the equity money that we can bring in to invest in companies. And I think in addition to that, typically we would say we're strategic investors, which means that we would bring strategic benefits to the startup. So I'll use Amazon as an example. So when we first invested in Rivian, which is another mobility car company, and we actually come in pretty early stage before they even design a car. So I would say like the capital in this case would be kind of quoted, right? So there's the cash capital, as I mentioned, but then there's more like a strategic benefit capital that we bring in. So with Rivian, we not only invest money in, but also sign a 100,000 vehicle purchase agreement with them before they even have the design. So there are several components to it. One is we participate and help them in terms of design the right van for kind of delivery use case for Amazon, but then also having Amazon on their customer pipeline and eventually customer base, it is huge for a startup, considering that if traction is actually like all the VCs are pushing startup founders too, right? So a strategic investor, if you use it right, and if you leverage your relationship with your investor right, you would be able to get not only the money, but I think more importantly would be the strategic relationship through the sales purchase order for Rivian, but then also like JDAs, commercial products or commercial agreements. And then if your company is really, really early, I think a pilot would be a really good way to kind of enter into that space as well. And I know that for many companies, and then I'm talking about like Shell, BP, Amazon, et cetera, because there are a ton of corporate ventures out there. Many of them actually have implementation team or like a portfolio success team or commercial technology adoption team. It's all different names, but then what they do is essentially the same to help startups to kind of get the internal business development. So make sure that you leverage that. And then with that rope, you might be able to get and establish a really meaningful relationship with internal BUs or kind of the parent companies, different business units. And then from there, get different kind of contracts to make sure that you can get not only the traction, but also help you on the product development side. So in terms of things to be mindful about, I think a common saying is be mindful about the bear hug, right? So Amazon being one of the largest company in the world, we have like a 1.5 million employees / contractors. It is a huge company. Like I probably get to know new Amazonians every day. So be mindful about how much time that you want to put in. And usually like I would ask startup to really kind of focus on prioritization. And then with the top, like maybe 3 opportunities, try to create a mafia map, like who are the decision maker, who are the stakeholder, who are the influencer, et cetera, to make sure that you're spending your time mindfully. But then also like be careful about the Chinese wall, right? Because there are very established VCs or CVCs like Amazon, which like a lot of my colleagues are having like similar to me, like a decade of experience as a VC. And then Shell Ventures, obviously, and then BP Ventures. These are all like a 10 years, 20 years experienced VC fund, which are very careful on this and then have established like a standard operating procedures. But then there are also like a newer funds or like less experienced corporate VCs. So be mindful that before you establish like your relationship with them, make sure like the discussion with the VC team versus like the business team, it needs to be clear cut, like separate. Like for example, for us, right, when we make that introduction and stuff, we don't really get in line of the business negotiation, and then we keep your data room or startup's data room to be like really kind of close to us, right? We are not sharing that with the business units because those are commercial sensitive information like CSI. So yeah, so this could be like a whole lecture, but definitely like make sure that you know the do's and don'ts and then do the homework. And I think overall corporate VCs can be very, very helpful in terms of getting you the money and then the strategic benefits.
Awesome. Thanks, Phoebe. And yeah, I would definitely echo also that kind of the de-risking element of having the corporate on board, whether it's a supplier or a customer or a partner. I think that's, in our experience, has been very helpful. Kirsten, wanted to come to you next. You guys have an incredible portfolio of companies, a lot of which are, as you say, these kind of moonshots, deep tech, in a lot of quite new areas. So across your portfolio, how have companies weathered the storm? And the ones who have done so well, what can you say about what smart decisions have they made, or what have they done differently?
Yeah, I mean, it's like we all know the last year and a half or so has been a tough capital market. I think what's remarkable as I look backward is truly how frozen, the venture markets were starting kind of in early summer last year and going frankly all the way to about early summer this year. I mean, truly frozen. And you kind of get it, right? There's no reason to do anything when there's so much uncertainty and there's for venture funds that have big portfolios, you're just focused inward. So I think there was a lot of that. In our portfolio, I mean, we have about 130 companies now, and in the last 2 years, over half of them were fundraising. So we got a lot of data. Not surprising. I think the companies that fared well during this period, first off, I think were the ones that identified the challenging market and were able to plan ahead and start a fundraising process maybe 12 or 15 months before they needed cash, because that's really how long some of these took. Now it gets to a bigger point, which is to do that, that's a position of luxury. You had to have had a lot of cash on your balance sheet which kind of goes back to this tried and true, thing that you hear about or that you see over all these cycles, which is that when markets are good, you really need to take advantage of them and raise a lot of money. And again, that sounds kind of obvious, but that's not always the case. We're always kind of cognizant of dilution and pricing and so forth, and we always think that the good times are going to keep on rolling. But we had a number of companies that I think took advantage of the prior market, were in a really good position, and then had the foresight to start a financing process with the expectation that it would take, up to 12 months or 14 months or whatever it may be. So certainly we saw that. I think, as the markets started thawing, if I get to using the analogy, and you started seeing capital flow back in, on the one hand, right, investors are looking for revenue, cash flow, the risk appetite is lower. That's kind of easy to say, and maybe it's kind of obvious. Again, if you have a portfolio of, development or early stage technology, you can't just turn on revenue. And so where we have seen companies be successful, and obviously, it's like any distribution, right? You have a lot that aren't, and you have some that are going to be the companies that have true differentiation, that are seen as kind of the number one or number two player in their space, where, if you're able to get to the end of the journey, you're sitting on a pretty good moat and a pretty good value proposition and a good way to capture that value. And the unit economics have to do this. So people are going to assess all that. And, again, it might sound obvious, but it's not always the case. If I look at carbon software companies, carbon management companies, there's dozens of dozens. If I look at like direct air capture companies, there's dozens of dozens. How many battery companies are there? There's a lot of these spaces that are highly, highly crowded, where you have good companies, but I think the differentiation, is a little bit murky. And what we saw in this most recent cycle is, even in a tough market, if you are seen as the one or number two player in a overall sector that has some tailwinds, there's going to be a flight to quality, right? And so we've been able to see some companies raise very, very large rounds. It's a little bit of kind of feast or famine. So that's been our experience. And as I mentioned before, if you don't find yourself in those positions, you've got to make aggressive and fast decisions to help position yourself better, right? So whether that's, cutting burn, whether that's trying to figure out a good monetization strategy, whether that's changing your business plan. We had a bunch of companies, I think, I don't want to say completely change, but redirect their business plan a bit in a way that allowed them to kind of get through the storm. So that's been our experience.
Super. Thanks very much. Kieran, why don't you come to you next? So as you mentioned earlier, so you guys are a slightly later part of the venture cycle and have, perhaps greater responsibility to your sort of shareholders. So just curious how you think about the sort of risks that you are and are not prepared to take, and what companies can maybe do early to position themselves well for capital like yours.
Yeah, so exactly right. And I think the panel have covered like the things that I would advise as well, that, generally we want to see that the core technology and the product market fit have been de-risked, that we think of ourselves as a really good partner for scale up, but not the right group to be making multiple bets, when there's still those technology risks in play. So clearly revenue helps a lot. In this space, it's not always feasible to do that sooner and to bring that forward. But I think that then puts more pressure on the other kind of validations, checks that you would look to, and kind of we'd want to see very solid proxies for that market fit and commercial traction, that this is the right solution. You have a customer, your customer really well, and actually they're already starting to put their hand up. So exactly as Phoebe described, I think the ecosystem engagement is super important. And I would add, not just for kind of bridging the valley, but also for us, how early stage companies engage with much larger incumbents and kind of survive or not that initial contact. And I think that speaks a lot to the commercial acumen of the team and the ability to kind of set the business on a more sustainable footing. So it's not just a case of signing up with these mega companies on terms that are kind of particularly egregious. That is not really setting up for success. So we certainly look at that a lot. I think Christian's exactly right. We're looking for the number one in the space. It's very difficult to make a case for someone who's kind of 1 of 10 in the current environment, particularly if you have some of those other risks that you're concerned about. And I think the only other thing that I would add is that I think it's really important. What I kind of suggest to earlier stage companies where they're kind of getting close to our range, I think it's just really important that each of your funding rounds, you have super clear milestones for what you're going to achieve with those, which of the kind of white hot risks that would be on my list you're going to be able to take away, and then showing an ability to execute on those. And I think in the scenario where there's nothing you can do, that the timeline is longer, then that means that you have to think about cutting burn and giving yourself the time to de-risk those. It's very difficult if the Series D pitch looks and feels the same as the Series C, then it's hard for us to take comfort. Like, okay, we're seeing the business build value over time, and it makes sense for us to come in early as opposed to kind of wait and see some more of those risks taken out. And if I could kind of one other soft point is that I think for institutions like ours, it's always great to get to know a team. And even though we're kind of later stage venture, kind of very happy to engage early on and without kind of taking up a ton of time to start building that trust and relationship and see how you're pivoting, what you've tried, what's worked, what hasn't. That clearly helps build conviction at the right time. So I think that's an important thing for us to be doing, and probably for earlier stage companies as well, to be thinking about who are going to be their next set of investors, and making sure you're having those conversations earlier.
Thanks, you super. And I just before I forget, I want to just kind of double click on one of the things you said, and then we can come back to the rest later. So when you're talking about kind of some of the commercial validation points, right, and then kind of noting that in some industries it might not be possible to have revenue. I think I was just curious, yes, especially as the markets have become a bit more conservative, whether kind of what the bar is for you, and whether you have some examples of, okay, if it's not revenue, what else does prove that product market fit, and the fact that the market's there and the customer is willing to pay? Just if you have any examples, maybe for some hard tech sectors that you've looked at.
Yeah, I mean, I suppose the closest is what Phoebe is describing, where you have kind of hard offtake agreements, which is saying, like, if you hit these milestones, if the technical parameters look like A, B, and C, then we're going to take 100,000 vehicles, or we're going to commit to taking X% of your capacity. I think that's the next level that we look to, and I think there it's kind of, again, it's worth having those conversations in quite a robust way, that it makes a big difference to us whether that is, I'm committing here, I'm partnering with you, and I've got skin in the game, and if you fail, I'm going to fail too. So we're, worst comes to worst, I'm going to be sending people in to help you out to make sure you get that, because that's where my trucks are coming from 2028 onwards, or whenever it is very different from kind of, we have an option, if we still feel this way in 5 years time, because I think that the risk on those type of things is that teams change, perspectives change. It's very difficult to even if you have something contracted, it's very difficult to then hold much larger companies to account. So seeing that kind of engagement and that kind of willingness to invest not just capital but time and effort, and share joint outcomes, I think that's the next best thing. And I think probably for us, the closest thing you can get to showing kind of good commercial traction and revenue potential.
Super. Thanks so much, really helpful. Kirsten, I wanted to come to you next. You have definitely the deepest experience of everyone here with aviation investment financial structure. So I was wondering, from your perspective, whether there are any trends, big themes to pull out over the last couple of decades on maybe new mechanisms, new areas that have received more or less attention than maybe was expected. And yeah, I guess taking that specific aviation lens, if you can comment on some of the trends we've been talking about. I think you're muted. Sorry.
I'll break it down, but thanks, Katya. I'll break it down between both aircraft financing and then the non-dilutive financing sources to companies that fit in the capital stack. To your point, historically, that outside of the commercial aircraft industry, the Boeing, the Airbuses, and even the regional airlines, financing was relatively difficult to achieve, certainly from the plethora of financial lessors out there. And however, on a good note, and it's been relatively surprising, because the new advanced air mobility industry, and particularly the area you're focused on, is similar to an airlines, where you're going to be used as a business tool, and you're going to be run, and you specifically are going to be run by airlines, it is making it a lot easier for those larger companies to look at financing new hydrogen aircraft or electric aircraft, as long as they're run as a money-making endeavor, commercial endeavor, instead of a use of business, because they like that counterparty risk, because they like that offtake agreement. So relative, I think people were very concerned as we kind of were at the beginning of this advanced air mobility entry, but now looking at it, recognize that your counterparties, the customers that you're going to be used for, are going to make it easier to finance because of that. The problem we do see is, how do you analyze the residual values? Because these typically have been asset-based businesses and done on some sort of amortization curve over a period of time. So I would predict, and what we're seeing in trends, is that the larger commercial lessors are leaning in. They're actually willing to make bids. They're having to show some sort of ESG and advancement kind of towards the decarbonization side, but they are also putting very short timelines on the residual value curves because they don't know where it's going to end up. And that is obviously means that you're going to have to end up generating revenue over a shorter period of time than, let's say, a traditional commercial aircraft like a Boeing or an Airbus would have. But I'm still very optimistic because these are going to be revenue producing assets, and they're going to, and more leasing companies or finance companies are going to need to meet their decarbonization. So they're going to have to lean into doing this. As we also look at the capital stack side, oddly enough, and in a good, because of that geopolitical instability and, let's say, the East versus West technological challenge, we are seeing the governments lean into industrial policy, to saying we need these technologies to be based domestically. We want our workforces to have these capabilities, and we're going to support basing them here. So whether it's the Department of Energy and their ATVM or Title 17, or recently you saw XM lean in through their CTEP program, which is their transformational technologies, China and transformational technologies, do a $169 million manufacturing loan to Beta. And I would expect, now those under XM typically have to be asset backed and with some TRL kind of 6 or 7, but I expect to see more and more of that. And we're also looking for additional levers within the DoD and other parts of the government that are looking to either provide non-dilutive capital sources or matching capital funds, such as the StratFi or TACFi programs. And again, that will help ease the burden for these capital intensive companies and to give them more incentive to be based here.
Super. Thank you. And Kim, coming to you, and you talked a bit about this already in the opening sort of statement, but I was wondering if you can dive a bit deeper into the trends you're seeing, and maybe also by sector, by stage, and in particular for the kind of harder tech, what you're seeing to work and not work across the data that you've been putting together.
Yeah, definitely. Well, I think across the board, the folks on this panel have given a really good overview on how to think about raising capital in this space if you're a founder. So wanted to do a bit of a zoom out view on how to think about what commercial milestones look like for sectors. And Katya, I know you and I have talked a lot about this, is understanding a better sector level framework for what these commercial milestones might look like. And so we ended up breaking this down into a few tranches, which I think people on this panel have spoken about. The way I summarize it is actually supply, demand, financing, and technology. So when you look at supply, I think the question to answer there is it getting built? You know, can you actually create the supply? In some cases, maybe that's projects. In other cases, maybe that's building, you know, equipment, or maybe that's retrofitting onto an existing facility. So that's kind of the question, is almost the project readiness level. Is there ground broken? You know, is there a lease? Is there an EPC? So that's starting to be data that we're tracking across these different sectors. We just internally on the platform published a data set on long duration energy storage to better understand how these more kind of novel up and coming technologies are segmenting across early stage stuff in the lab or pilot, and now reaching demonstration and commercial stage. So that's kind of thinking about it from the project or supply commercial readiness level. And then there's the technology side, right? Of course, that's you know, where early stage innovation plays. What does the benchmark look like today, and how do you as the technology, innovator, get to cost competitive. So that's kind of the TRL side that we all know and love very well. And then I think a big part of this that we're now starting to dig into is on the demand side. So can you get demand for it, and at what scale? Is there a willingness to pay? And that offtake demand looks a little bit different, right, in different sectors. So if you're thinking about a chemical sector, it's actually a bit more commodity based. You don't see, 7 to 10 years and sort of binding offtake agreements, but you sell onto the commodity markets. I'm not an expert in aviation, so I don't exactly know how it works, but was writing down notes on what Kirsten was saying. In power, you do see longer term sort of PPA. So there's different form factors for this offtake demand, but I think the market is waking up to the fact that LOIs and MOUs don't necessarily count anymore. It's important that there's some sort of binding or hard offtake agreements that you can eventually build cash flow off of. And then I think on the demand side too, another core element or subsegment of this that we're starting to look at more closely is policy. So policy is a big generator of demand, whether it's carrots or sticks, right? So in the US, they seem to have taken more of a carrots approach. So tax credits, subsidies, like the EV tax credit can be a big driver in demand. More funding in the space as well can be a big driver in the demand. In Europe, I think they have historically taken more of a regulatory or sticks approach. So like CBAM is a good example, carbon border adjustment mechanism, which is kicking in 25 or 2026, I think. But that'll also be a huge lever for decarbonization and corporates starting to think about how do we actually do these hard to abate sectors, and transportation sectors like maritime or aviation, I think, will be a core question because they span across different geographies. And then finally, there's procurement accelerants as part of the demand piece as well. So advanced market commitments in the broader aviation space. There's trends we're seeing now in book and claim for, at least for SAFs, sustainable aviation fuels, which acts similarly to RECs in the power market. So separating out the environmental benefit from the actual physical delivery of the good. So there's a couple different, mechanisms we're seeing on the demand side. And then finally is financing, which is obviously what we're talking about here. But financing is almost an ends to a means. It's a component of these different levers: supply, technology, and demand. But that question is, is there money for this, and can it scale deployment? I think one thing that's not talked about as much, but is starting to be talked about more, especially in terms of de-risking some of these aspects, is insurance as an enabling sort of financing unlock. So starting to see, at least in energy and carbon markets, not sure if there's a play yet in aviation, managing general agents or MGAs, starting to ensure, the credit worthiness of off-takers, which can make or break whether or not something is bankable, or ensuring the delivery risk of certain projects. So there's a few creative accelerants we're seeing on the financing side beyond just, needing more financing and different types of financing across the capital stack. But I think it's really zooming out and looking at these four sort of legs of the chair, so to speak, to really measure whether or not these sectors are starting to reach their commercial inflection point. And so we're starting to take a more sector by sector look at what that framework looks like.
Awesome, thank you. And just a note to the audience, please feel free to send questions into the Q&A chat, and I'll pick up some of them as they come through. But in the meantime, just wanted to ask a question, and feel free, anyone, to chime in. I guess we talked quite a bit about policy and sort of non-dilutive funding and things like that. So I was wondering, I guess in particular for the investors here, as you look at these kind of hard to abate, difficult industries, do you build them in policy support and incentives into kind of your base case, or do you build a standalone investment case and this just kind of comes on top if it comes, but if not, it doesn't? Because it does, on one hand, it feels like it's playing a larger and larger role, but at the other, I think we all know that it's not always stable and predictable. So just wondering how you think about it in your investment thesis.
I think it's really kind of case by case, right? And then I think different investors actually have different ways of doing this. There are a few kind of philosophy that we adopt. One is like for the near term, if we see the policies are being able to make into impact, and then we already see the money being deployed, then we would have, like, at least in the near term, we would bake that in. And then in the long term, there is like a standalone. But usually we would have like a base case and then you have high case and low case, right? So you can kind of twitch the toggle. Personally, I would always kind of encourage the entrepreneur to think in the non-policy, like a favorable environment, because you never know, like in 4 years or in 8 years, what the political environment would be. So it is always good to have a very healthy unit economics, and then just only treating the policy as kind of the sweetener, helping you accelerate or catalyze in the near term.
And I'll think of it as an approach kind of with the non-climate hat on, where climate policies can come in and out and be capricious to political times. I think when you look at something from a capital structure approach and more of the manufacturing, that if you're building something, it makes sense to, let's say, capitalize or leverage the hard assets, the piece of property or a building or manufacturing. So when we do look at those type of companies that are building a manufacturing facility or have some sort of presence like that, we do recognize that those can be levered and don't have to be funded entirely with equity. Or if, say, you're building an airline and you don't need to fund that airline with all equity because, again, you have assets to pledge, and that's not necessarily at the political whims of policy. So I think it really is an understanding of capital structures and where something may be not necessarily needed to be funded with straight equity.
Yeah, I think probably in most cases you'll struggle to make this work if you say, I'm not going to put any value or ascribe. I'm going to run a case which doesn't have these kind of regulatory tailwinds built in, because we're generally dealing with a market failure. We're generally dealing with products which require investment and a higher price point in order to be competitive during that transition period. I think the challenge is exactly like Kirsten already said, that the policy environment is just less predictable now across all spaces, but this one as well. And so it's kind of which of those initiatives do you align up closely to, and what's your track record in going out and getting those non-dilutive sources of funding. I think it's important to build the case for you'll be able to do that over time, and that you'll have multiple avenues if different policy routes change, and also that your kind of key customers are facing those same pressures, and therefore they're also needing to get ahead of the curve and are willing, like I said before, to kind of put skin in the game early because they know that, or they anticipate that they'll be facing those same sorts of regulatory hurdles and will need support in helping it. But I don't think it can be excluded probably in most cases.
Awesome, thank you. And very unfortunately, we're now out of time. So I just want to thank you all panelists for great participation, discussion. Really enjoyed it, and thank you everyone who tuned in. And I'm gonna now pass over to Dom to wrap it up. Thank you so much.
Thank you, Katya. Thanks for having us.
Brilliant, thank you, Katya. That was an absolutely brilliant session, and another good one to close on. I mean, we heard some fantastic sound bites, such as be careful of the bear hug, make yourself a mafia map, and just really interesting insights into how investors are thinking about what startups and scale-ups in this space looking to progress hydrogen and other sustainable aviation technologies need to do, given the long timelines and uncertainty around regulation. So brilliant stuff. We had a kind of final poll there to wrap up as well, with asking the audience, do we think that we'll have enough financing in place to drive this transition at the right pace? And we were fortunate to see 43% think the funding will be in place, which is higher than the no, but many not sure. So yeah, really interesting to see that as well. Clearly there are some headwinds in terms of securing capital, but there obviously are also a lot of government initiatives, and we heard about the public sector leaning in to support some of those gaps. So yeah, we've had a great day. We've covered off a lot of points. We'll give a kind of full recap of what we covered today, the first thing tomorrow. We'll be starting again tomorrow at 4:15 p.m. About 4 p.m. UK time, so 11 a.m. Eastern. And we'll be looking primarily at clean flight for passengers and cargo, and when, where, and how. So we'll be moving from this look at kind of some of the technology bricks and where the funding comes from, to really thinking about the routes that are going to be in place, and looking through different time periods when we can expect to see aircraft flying and what sizes and what routes they will be. So we'll be starting again. We've got a 3:30 p.m. start here. We'll actually start a little bit later at 4 p.m. And then we'll go straight into our first panel session tomorrow. So yeah, please do join us. We've got lots and lots of questions that we haven't got to, lots and lots of commentary. We're going to review all of that after the fact, as we've done in each previous Hydrogen Aviation Summit, and we'll go back and provide and publish some of the answers on our blog to some of the things we didn't get to. So I do really thank everyone for those questions, and we hope to answer as many of them as we can tomorrow and then subsequently. But do also, when you're on tomorrow, please come and visit the expo, talk to our BD, our supply chain procurement team. So you'll be able to log in from 3:30 p.m. Tomorrow, and you'll be able to kind of visit and have a chat, especially if you are a graduate or you're looking at you have an interest in careers in sustainable aviation. Please come and join, because we also have our talent acquisition team there on one of our expo stands. So fantastic. Thank you everybody for the time today. See you again tomorrow.